I was looking at the stack of materials for today's deep dive, and I had this vivid flashback to my college days.
Oh, I think I know where this is going.
Yeah, that feeling when you crack open a textbook for a 400 level class, and you realize you don't just need to learn the concepts, you have to learn a whole new language first.
Oh, absolutely. It's like opening a book on astrophysics and realizing you forgot how to do basic algebra. The vocabulary alone is just a massive barrier.
That is exactly the vibe I got looking at the Stock Options book, 24th edition. I mean, we are talking about a mashup of tax code, securities regulations, accounting standards. It's dense.
It is.
But, looking through the listener feedback and the exam guidelines, there's a real silver lining here. The consensus is if you can just nail the foundation, specifically chapters 1 through 3, you're basically halfway to passing the CEP exam.
That's a very fair assessment. Those first 3 chapters are the bedrock. If you don't get the fundamental definitions, or say the difference between Section 83 and Section 422, the later chapters are just going to sound like noise.
So that's our mission today. We are doing a dedicated exam prep deep dive. We're stripping this down to the studs, strictly focusing on chapters 1 through 3. We're going to try and synthesize those dense legal codes into clear, memorizable concepts. And to keep you and me on our toes, we've got 3 knowledge check questions sprinkled throughout.
I love a good quiz. It forces you to actively recall the information,
Yeah,
instead of just letting it wash over you, which is a real danger with tax statutes.
it really is. So here's the roadmap. We have 3 pillars today. First, the basics, definitions, and the regulatory landscape.
Okay.
Second, NSOs, non-statutory stock options, the absolute workhorse of the industry.
Right.
And third, ISOs, or incentive stock options, the gold standard that comes with a whole lot of strings attached.
Sounds like a plan. Let's start at the very beginning, Chapter 1.1. What exactly are we holding when we hold a stock option?
Right. At its core, a compensatory stock option is a contract. It's a contractual right to buy a certain number of shares at a fixed price for a fixed period of time.
And the key word you use there is compensatory. We aren't talking about day trading or, buying calls on an app here.
Yeah.
These are granted for services. The person getting the option E, is providing labor, and the company is providing this potential for equity in return.
And the source material immediately splits this universe into 2 very distinct buckets.
Correct. You have statutory options and you have non-statutory options. Statutory options are the ones specifically created by the tax code, so incentive stock options, or ISOs, and employee stock purchase plans, ESPPs.
And they have their own little section of the code.
Yep, they live under code sections 421 through 144. They are creatures of statute.
And the non-statutory options.
That's everything else. We call them NSOs. And really, they're just options that don't meet the super strict requirements of those statutory plans. They're governed generally by Section 83 of the Internal Revenue Code.
So statutory gets special treatment. Non-statutory is the default.
Got it.
Now, Chapter 1.2 introduces this concept that I immediately started calling the 3-headed monster of regulation.
Huh. That's a good way to put it.
It feels like managing options is like trying to satisfy 3 different bosses who refuse to talk to each other.
That is a very accurate analogy. You're dealing with 3 distinct regulatory bodies, and they all have completely different motivations.
Let's unpack them. First head of the monster, tax law.
Right. So this is the IRS and the Treasury. Their main concern is collecting revenue.
Yeah.
Full stop. They care about when income is recognized and how much tax is owed. This is where you get the code, the regulations, all that. They just want their cut.
Then we have the second head, securities law.
Administered by the SEC. Their goal isn't tax revenue, it's investor protection. They want to make sure people aren't being scammed and that there's full disclosure.
That's the 33 and 34 acts.
Exactly. And don't forget the state level, the blue sky laws.
Blue sky laws. I've always loved that term. Where does that even come from?
It's an old legal term from the early 1900s. Judges wanted to protect investors from these speculative schemes that had, no more substance than so many feet of blue sky.
So basically, selling nothing.
Precisely.
That's fantastic. Okay, and finally, the third head, accounting rules.
That would be FASB, the Financial Accounting Standards Board. They don't care about the employee's tax bill or fraud. They care about the accuracy of the company's financial statements. How does this option grant affect the bottom line? And the key standard here is ASC 718.
And the book mentions a 4th category, miscellaneous laws, just to make it even more complicated.
Right, Chapter 1.2.4. This catches things like ERISA. Usually, stock plans are exempt, but you have to be careful not to design them in a way that accidentally triggers it. And then you have just basic contract law, because an option is a contract.
The text points out a crucial conflict here among these heads. Something might be great for tax purposes, but a total nightmare for securities law.
Exactly. For example, you might design an ISO to have a long holding period to get the employee a tax benefit. But if that executive tries to sell stock to meet that period, they might run smack into insider trading rules that forbid them from selling. The three heads are often biting at each other.
Okay, this is a perfect spot to pause. Before we move on to the specific option types, time for our first knowledge check.
Let's hear it.
Knowledge check. Question number 1. If a company grants an option that is intended to be an ISO, but it fails to meet just one of the specific requirements of Internal Revenue Code Section 422, what category does it automatically fall into, and which code section primarily governs its taxation?
Ah, a classic exam trick question. There is no almost ISO category. If it fails, it automatically defaults to a non-statutory stock option, an NSO.
And the governing code section?
Because it's an NSO, it is primarily governed by Section 83 of the Internal Revenue Code.
Spot on. If you break the rules of the special club, you get kicked back out to the general population.
And that connects us perfectly to Part 2 of our deep dive, non-statutory stock options, covered in Chapter 2.
Right. NSOs seem like the flexible friend of the equity world.
They really are the Swiss Army knife. Because they don't have to meet all those strict statutory rules, you can do a lot more with them. You can grant them to employees, sure, but also to outside directors, contractors, consultants. ISOs are strictly employees only.
And what about the price? Do they have to be granted at fair market value?
So this is a critical area. Technically, under corporate law, you could grant them at a discount. But, and this is a huge but, Chapter 2.6 warns us about the trapdoor known as Section 409A.
Section 409A, the scary code section everyone whispers about.
It's the one you want to avoid at all costs. If you grant an NSO with an exercise price lower than the fair market value on grant date, you trigger 409A, and the result is a disaster.
What happens?
The option faces immediate income inclusion at vesting. Not exercise, but vesting, plus a 20% penalty tax, plus interest penalties. It's brutal.
So while NSOs are flexible 99% of the time, you're still going to price them at fair market value just to stay safe.
Precisely. You do not mess with 409A.
Okay, let's talk about the normal tax life cycle of an NSO. I get the grant, I wait for it to vest, and then I exercise. When does the tax man come calling?
For an NSO, the tax event happens at exercise. Assuming the option was vested, that is the moment the transaction closes for tax purposes.
And what am I taxed on?
You are taxed on the spread. That's the difference between the fair market value of the stock on the day you exercise and the price you paid for it. That spread is treated as ordinary income.
So it's like getting a cash bonus.
Exactly. Just like a cash bonus, but paid in stock value.
And here's a point the book emphasizes that I think people miss. The relationship between the employee's tax and the employer's tax.
Yes, the symmetry in Chapter 2.7. It's beautiful in a tax law kind of way. The amount that the employee claims as ordinary income is the exact same amount the employer gets to claim as a tax deduction.
They're mirrored.
Perfectly mirrored. If the employee pays tax on $10,000 as spread, the company deducts $10,000 as a compensation expense. It's why companies generally like NSOs. They get a tax break.
Now, we mentioned Section 83 governs NSOs. We need to dig into the mechanics of that, specifically this phrase, substantial risk of forfeiture.
Right. So Section 83 says you're taxed on property when it's transferred to you, unless it's subject to a substantial risk of forfeiture. In plain English, if you get stock, but the company can take it back if you quit, well, you aren't taxed on it yet because it isn't fully yours.
That's vesting.
That's exactly what vesting is. It's the lapsing of that risk. For NSOs, taxation happens when the risk of forfeiture lapses, or IR when the asset is transferred, whichever is later.
Which usually means exercise.
Right, because you don't get the stock until you exercise, and you usually don't exercise until you vest, so the tax event is pushed all the way out.
But the book mentions a nuance in Chapter 2.3.1 called non-lapse restrictions. How is that different from vesting?
Good question. A non-lapse restriction is a permanent limitation that never goes away. So think of a rule in a shareholders agreement that says you can only sell this stock back to the company at its book value. Since that restriction never lapses, it actually lowers the value of the stock for tax purposes permanently. It's different from vesting, which does eventually end.
Got it. Okay, let's talk about the loophole, or maybe the strategy, the gambler's choice. Section 83B.
This is one of the most tested concepts in the book, for sure. This applies when a company allows early exercise, letting you buy the stock before it even vests.
So I'm writing a check for stock that I might have to give back if I quit my job.
Correct. And normally, because of that risk, you wouldn't be taxed until vesting. But if you file a Section 83B election with the IRS within 30 days, and that deadline is absolute, you're choosing to be taxed now at the time of purchase instead of waiting.
Why on earth would I do that?
To freeze the tax. If you exercise when the price is $1 and the fair market value is $1, your spread is zero. You pay zero tax. By filing the 83B, you're telling the IRS, I'm closing the compensation chapter on this stock right now.
So if the stock goes up to, say, $100 when it vests,
You pay zero tax at vesting. You already handled the tax event back when the spread was zero. And when you eventually sell that stock, all that growth becomes capital gains.
it sounds perfect. So why did I call it a gamble?
Because if you leave the company and you have to forfeit the stock, you don't get a refund on any taxes you paid.
Yeah.
And, maybe more painfully, you paid cash for stock that you now have to give back. You could lose your capital investment. It's a real risk.
Before we move on, I saw a section in Chapter 2.5 about qualified equity grants under Section 83 IABROS. This feels newer.
It is. It came from the 2017 tax reform. It was designed to help employees at private companies who exercise options but can't sell the stock to pay the tax.
The liquidity crunch.
Yes, exactly. Section 83I allows some employees to defer paying that income tax for up to 5 years. But the requirements are incredibly strict. It's honestly a nightmare to administer, so we don't see it used very often. But for the exam, just know it exists.
Okay, that is a lot of mechanics. Let's see if everyone caught the main point on 83B.
Time for question 2.
Knowledge check. Question number 2. An employee exercises an unvested NSO and properly files a Section 83B election. 3 years later, the stock vests when the price is tripled. What is the tax consequence on that vesting date?
The answer is zero. Nothing. Because of that valid 83B election, the tax event was accelerated to the date of exercise. The vesting date becomes a complete non-event for tax purposes.
I love that. A non-event. The
Yep.
best kind of event in the tax world. Okay, moving on to part 3. The gold standard. Incentive stock options or ISOs.
Right. Chapter 3 is where things get really strict. ISOs are designed to be a tax-favored investment vehicle for employees.
So what makes them the gold standard?
The primary benefit, the big one, is that there is no ordinary income tax at exercise. With the NSO, you pay tax on the spread immediately, right?
Right.
With an ISO, you exercise, you get the stock, and for regular tax purposes, you pay nothing that day. The tax is deferred until you sell the stock.
And if you hold it long enough and it's all capital gains.
That is the dream scenario, yes.
Yeah.
But because the IRS is being so generous with the tax treatment, Congress put some very strict padlocks on Section 422 to prevent abuse.
Let's run through those requirements.
Okay. First, as I mentioned, employees only, no contractors. Second, there has to be shareholder approval of the plan itself.
And there are term limits, right?
Yes. The plan usually expires in 10 years, and the options themselves can't have a term longer than 10 years.
And the price.
It has to be at least fair market value at grant. And Chapter 3.2.5 mentions the special rule for the big owners, the 10% shareholder rule. If you own more than 10% of the company, your ISOs have to be priced at 110% of fair market value, and they can only last for 5 years, not 10. Ouch! The price of power. Okay, now there's one rule that I think confuses people the most. The $100,000 limitation.
The spillover rule. Yes, this is Chapter 3.2.6. This rule says that you can only have $100,000 worth of ISOs become first exercisable, so vest in any single calendar year.
And that value is based on what? The current price?
No, and that is the key thing to remember. It is based on the fair market value at the date of grant. It's static. So if you have $150,000 worth of options vesting in 1 year, the first $100,000 are ISOs. The extra $50,000 automatically spill over and become NSOs.
So you end up with a split grant, effectively.
Exactly. It's a very common situation.
Okay, so I have my ISO, I exercised it, I paid no tax. Now I want that sweet capital gains treatment. I have to hold the stock. What are the magic numbers?
You need to satisfy a dual holding period. You must hold the shares for 2 years from the grant date and in 1 year from the exercise date.
Both must be true.
Both. If you sell before satisfying either of those, you trigger a disqualifying disposition or a DD.
And what happens then? The IRS basically says, nice try. The benefit is lost. The spread at exercise becomes ordinary income in the year you sell. It essentially just reverts to being taxed like an NSO.
Now, here is where it gets really interesting, or maybe terrifying. We said there is no regular tax at exercise. But there's a shadow tax lurking in the background.
The AMT, the alternative minimum tax. This is the hidden trap in Chapter 3.4. While that ISO exercise isn't taxable for regular income tax, the spread on it is considered a preference item for the AMT calculation.
So you could exercise, hold the stock, haven't sold a single share, and still owe a massive tax bill in April.
Yes. You can owe tax on paper gains. If your spread is large enough, it pushes your income over the AMT exemption, and you have to cut a check to the IRS even though you have no cash from the stock to pay it.
That sounds dangerous, especially if the stock price crashes after you exercise but before you can sell.
It has been historically ruinous for some people. It's why planning is so essential with ISOs.
Is there any way to mitigate that?
Actually, yes. Chapter 3.4.3 mentions a great pro tip. You can file a Section 83B election for AMT purposes if you early exercise an ISO.
Wait, I thought 83B was for NSOs.
It's usually for NSOs.
Yeah.
But with an ISO, you can use it to lock in the AMT preference item at 0, assuming you exercise right at grant. It doesn't affect your regular tax, but it stops that AMT spread from growing as the stock price grows. It's a very sophisticated move.
That is a deep cut. Okay, we are deep in the weeds of holding periods, so let's pull up for our final test.
Knowledge check number 3.
Knowledge check question #3. To qualify for long-term capital gains treatment on an incentive stock option, an employee must satisfy a dual holding period. What are those two specific timeframes?
You have to hold the stock for at least 2 years from the date of grant and 1 year from the date of exercise.
Perfect. 2 and 1. Tattoo that on your brain for the exam.
Please don't actually get a tattoo of the tax code. The regulations might change, and then you're stuck with bad ink.
That's very valid advice. So let's bring this all back together. We've covered a lot of ground.
We have. We established the framework, the interplay of tax, securities, and accounting the three-headed monster.
Then we looked at NSOs.
The default option. Flexible, governed by Section 83, taxed as ordinary income at exercise, and the company gets that tax deduction.
And finally, ISOs.
The statutory option, governed by Section 422. Tax deferred until sale, but subject to all those strict rules, the $100,000 limit, and the dreaded AMT. And critically, the company gets no tax deduction unless there's a disqualifying disposition.
Which brings us to a provocative final thought. We always talk about ISOs as this perk, this better option. But when you look at all the complexity, the AMT risk, the holding periods, it raises a question.
It does. You have to ask, is the benefit of an ISO actually worth the administrative burden and the risk? We see so many employees accidentally trigger disqualifying dispositions anyway.
Right, they effectively turn their ISOs into NSOs after all that hassle.
Exactly. If you're just going to sell immediately to cover the exercise cost or the taxes, you've made it an NSO. So maybe the basic NSO isn't so bad after all.
Maybe it's cleaner, safer.
It's certainly cleaner. But as long as the spread between ordinary income rates and capital gains rates is significant, well, people will always chase the ISO dream.
That is plenty to chew on. If you are prepping for the CEP, remember, get the definitions right in Chapter 1, understand the mechanics of Section 83 in Chapter 2, and memorize those holding periods in Chapter 3.
Absolutely. The rest of the book builds right on this foundation.
Thanks for diving in with us. Good luck with the studying.
Good luck.